All right, so the moment has arrived that many of us have been hoping for, wishing for, waiting for. No, it's not the news that you won the lotto. You got to buy a ticket for that. This is, as this video, whenever you watch it, maybe you'll watch it, it'll come out before, after, whatever. We will know the fate of what the Fed's going to do for a rate cut. But definitely, they're going to do a rate cut. My prediction is they're going to do 0.25, quarter cut to 50 basis points, but we're thinking a quarter. I don't think they're going to do the 50. If they do a 50, it would be definitely a little bit of a surprise. I think they do a quarter because they're going to want to hold more fuel for the fire. And the reason why they would not do 50 is because, look, I mean, according to data, and look, I know we all live a life and we might think our business, our job, our commissions, whatever, it's not really going that great, doesn't feel that great, but you know, GDP doesn't feel that great. Maybe the consumers that are coming to your restaurant, your business, your store, your rents have gone down. Maybe, you know, like it just, the rates suck. Maybe life's just harder and you're not feeling like, what are they talking about? Things are good. I don't see that. I don't sense that. I don't hear that. Because when you say people are struggling to pay their bills, things are expensive, gas, rent, food, everything, right? Travel's expensive. What else? Rates suck compared to when it's hard when you go from very, very low rates for a while, for a long time, and they get high because things were built off that low rate, right? So, but I wanted to go on this video today. I wanted to kind of dive into what are some of the predictions of the rate cuts, let's just say over the next 12 months. Because that's what a lot of you asked. One of the biggest questions is, hey, Kenny, what do you think is going to happen to interest rates as we move over the next 12 months? It's not an easy question to answer for anybody. The Feds can't seem to get it right. We're trusting data that does not seem like it's right. And we're supposed to make predictions. We're supposed to tell clients what we think. We're supposed to advise. We're supposed to make decisions. We're buying a house, refi, buying investment properties. Do we refi now? Do we wait? You know, whatever it all is, right? I want to maybe move, but I got a 2.5. Will rates ever get here? It's all these what if unknown questions. So all we can do is we got to live in the data, because the data at the end of the day does tell a story. If the data continues to get worse, then obviously rates are going to go lower faster, because the Fed's going to have to move, the market's going to smell it out, and we're going lower. And what data exactly are we watching? And then after that, let's get into some of the predictions. I'm going to read some notes, what some other people are thinking, and we'll kind of dive into it. See where rates would ultimately maybe end up. What data? Number one data that trumps everything is going to be jobs. If you ain't got a job, you ain't got the money. If you ain't got the money, you cannot pay bills. And if you can't pay bills, that is a problem to the American economy, because 70%, if not more, of our economy is people what? Making money and spending money. And if you ain't got the dough, you ain't got the flow, and that is a problem. So number one, jobs is going to always be at the front and center. Sometimes it could seem like it's in the back because it's doing well, they're not worried about it, but as soon as that switches, like it's been switching, it comes right to the forefront and will trump anything else. Number two, obviously, is inflation. Inflation. So what you're probably going to hear out of Mr. Powell, he's going to talk about maybe the economy softening, the jobs market's weakening, and then he's also going to talk about he's still concerned for inflation because of tariffs. Is it a one-time inflation? Is it going to hit? A lot of people are predicting inflation is going to get worse next year. You're hearing the Trump administration say all this money is going to come into our country next year. I don't know, it's 5 trillion, 10 trillion, or whatever the hell the number is. They're going to build all these plants. They're going to have all these construction jobs. You're going to see GDP off the chain. You're going to have, jobs off the chain. That means people are going to have a lot of jobs, a lot of money flowing around. Look, if you bring $10 trillion into this country and start building stuff and hiring, excuse my French, that is a shit ton of money going around, and that is going to do something. That eventually lands into the pockets of consumers, and eventually that stuff starts to get spent, whether it's on food, gas, electricity, cars, vacations, bars, houses, investment properties, stocks, crypto. Come on, the whole thing, guys. The money just flows. So the third thing I think, which we'd be watching about data, is it's not talked about as much, but it's going to be the overall market, the consumer, the GDP. So obviously, if the jobs goes to shit, that's one thing they got to start cutting quicker. If inflation starts getting out of control, they got to watch that too, because if you have bad jobs and inflation, you could have stagflation. And the next thing is, if the jobs seem like, they're doing okay, inflation seems like it's kind of chilling, but all of a sudden you're seeing GDP go down, the consumer starts pulling back, and just signs of the R word, the recession, that's another thing that has to get dealt with by the overall Feds, the administration, the Treasury, the whole thing, right? So that is the data I'm talking about. Yes, there's so many little micro macro little things within that, but the big picture is that's what we're looking at. So that's what we should hear out of Powell's mouth and talk about the jobs market. What we really want to focus on is not the cut, because look, I'm going to say this again. If you follow me on social, I've been talking about it, and let's repeat this phrase over and over. The cut is already baked in the cake. It's already baked into the pricing. The 30-year fix is everything you see. It's already baking in. It could be over baking. So that means once they cut, you could see the 10-year treasury move rates get back. What the hell's going on, guys? Because a lot of anticipations in this cut. So basically that's what you're dealing with right now. So don't be surprised after the cut if you see rates get a little bit worse or things, it doesn't improve. How could potentially rates get better? Maybe they cut more than we thought. But the bigger thing is how I think rates could get better quickly is why Powell's speaking potentially is if he starts to become dovish, if he starts to be overly concerned about the economy, overly concerned about on the jobs market. Maybe he's less concerned about inflation. Because the other thing is these tariffs are legal. What if the Supreme Court deems them illegal, says they cannot go on, send the money back, all this whole thing's over, which honestly, I don't even know how I'm going to comment on it. Let's just say that happens. That means we go from inflationary to deflationary very quickly. So does that mean that inflation drops dramatically and the Feds start cutting faster? I don't know. But these are all the things we have to talk about. These are all the things the Feds think about. This is what's going through all their minds. There's so much things to go through, but at the high level, this is what's going on. Let's dive into, I'm going to look and see what predictions are for the Fed's rate cuts, and then what does that ultimately mean for long-term rates? Where do we think things could head? Obviously, guys, let me just be straight here. I don't know what the future holds, nor does anybody else that comes on here or any front of microphone or camera or social media or YouTube video or whatever. Nobody knows diddly squat. We can only go by what we think, we predict, and we're going to give you the best estimates anybody can, just like I will today. And could I be wrong a lot? Sure. Are most people wrong a lot when predicting stuff? Sure. But the data, when it comes out, we can read it. It's real. It's not just a myth unless it's made up and it's incorrect, which we would never have that in the job sport. We would never miss 911,000 jobs in 1 year. We would never overprint that, would we? Of course we would. Let's see what some of the predictions are here. Okay. Goldman Sachs predicts the terminal Fed's fund rate levels to be cut off to be around 3 to 3.25. The Feds are thinking they're going to cut 50 to 75 basis points this year and maybe 75 basis points next year. So if we're at 450, we go down 150 basis points, you're at 3%. And so Goldman's around there. What are the driving factors? Economic slowdown, weakening labor data, downward visits to jobs report, inflation remains a concern, so cut will depend on that, especially on CPI, PC, core inflation, how quickly supply chain wages pressures ease. Experts say mortgage rates may fall somewhat, but likely above 6% for a 30-year fix because of sticky inflation. Well, we're kind of there on some scenarios. You're already there. If you're paying points, you're already under there. The modest rate cuts starting September 2025, possibly 3 total by the year end. Mortgage rates will go down, but not as much as they hope. Likely remain stuck in the high 5s to low 7 range for 30-year fix. Low 7s, we're definitely past that. Borrowers locking rates if advantageous because upside risk inflation yield spikes remains. Long-term rates will move on inflation, economic growth, bond market demand. So watch those importance for the Fed announcements. So the Fed's long-term rate by early 2026 is thinking it's going to be a 3.25 to 350 basis points. That's up to 100 basis points cut. That's what we're kind of looking at. I'm just reading a bunch of different stuff and I had some notes here. So with that being said, Kenny, what the hell does that mean for interest rates? Because that's what everybody's asking. That literally is what everybody's asking. So what does that mean? So if we get a quarter cut, the 10-year treasury, I'm just going to call it 4%. It's sitting right around there. So let's talk about a couple things that we go over, and then, we can wrap this video up. And if I can help you answer any questions, go over any scenarios, price them out, let me know, reach out to me. I'm going to start sending out a weekly email. It's going to be scenarios, different scenarios on there, some pricing and things. So that way you can gauge, maybe you have something close, what we're looking at, and see what's out there. So there's many ways to talk about this, but let's just talk about what could potentially affect the rates and how they can go down. Number one, the Fed's cutting rates. Does it mean long-term interest rates will go down always? No. Could they go down? Absolutely. What could make the 10-year treasury go down? Obviously, a more dovish Fed that's going to cut the 10-year treasury go down. That's number one. Number two, over time, if the Feds were to cut 100 basis points, would rates potentially be lower than they are now? The answer is yes. Okay. Number three, what else could possibly bring interest rates down? Remember the spread between the 10-year Treasury, 30-year fix? There's a half a point, 75 basis points in there. So let's just say today the rate's 6.25, no points, 30-year fix, blah, blah, blah scenario. I'm just picking a number, and the spreads were to come down to normal levels. You could be looking at potentially a 5.75. So that's one thing. If spreads could come down, they've been coming down and they'll continue to probably come down. So that will be good. Number two, now that the bank rules lessen, so banks can put more money into treasuries, or stable coins could go into treasuries, things like that. Trillions of dollars could go into treasuries. That could help bring treasuries down. What else? Well, the Federal Reserve, maybe the Treasury, they could buy mortgage-backed securities, treasuries, and help bring the rates down. Sure. Bill Poultry ahead of Fannie and Freddie could lower loan level price adjustments. That could bring rates down. That means when you get a primary, second home, investment property, there's cuts, there's hits to the rate because of FICO and LTV, things like that. Those could be less hits. That could help bring rates down. So what does all this mean? If the feds really do cut rates, let's say 100 basis points from now until middle of next year, if the spreads really do improve, let's say 30 basis points, and there's some love with some of this SLR and things like that, service level premiums, things like that, service leverage ratio, some of this other stuff that could bring rates down, and Bill Poultry gets in there with all this, I could easily see rates coming down from this point 50 to 75 basis points, maybe 100 basis points by this time next year, because we already have a little push down now, so that could get back. But from today, if rates went down 50 or 75 basis points, now you're talking mid to low fives on a conventional no points. You're talking FHA, VA, no points in the high fours. You're talking ARMs in the fours, jumbo in the low fives. You're talking commercial loans in the fours and fives. So if I got your attention, there's other levers to pull than just the Fed. So over time, I think we'll see rates improve. I would say 50 to 100 basis points lower. So if we're at 6.25, 5.75, maybe all the way down to 5.25 on the conventional rate. So there's room to go. So a lot of people are, should I refi? Should I wait? It's really up to you. If you are going to refi and you can really save the money, maybe don't pay a bunch of points, maybe don't pay a bunch of costs, just try to do no cost, no points. Maybe just save the money, because if you can do this again, you're going to want to have that opportunity. If you're getting a non-QM loan DSCR, be very careful in the locking a 3-5 year prepay, because then you're going to be stuck out from refinancing and you're going to hate your life and wish you never did that. And for those of you who've never been through a rate environment like this, or through a pullback turn, like or real estate got tougher, it wasn't as easy like coming out of the pandemic, where everybody looks like a genius. A lot of people come out of 2008, took a lot of loans, took a lot of prepays on the commercial side, did a lot of things. They're like, I shouldn't have done that, because they panicked and their rates came down and they're locked in these crazy prepays and could not refi out to take cash out by the building. So it really affected their life and they're not happy about it. So what I will say again, I will repeat, if you can lock now and save the money, do it. I wouldn't pay a bunch of points. I would not go and get some long-term prepay. 1 year is okay. 2 year to me is max. And so you'll see rates come down, and I think it will help a lot of people out. If I can help you, let me know, and we'll continue to go over this stuff. But I just want to come on here and let you know that I think the Feds are going to cut today. I think they'll cut anywhere from 2 to 3 times this year, and maybe Powell before he leaves office in May, June, or whatever he leaves of next year. Maybe we'll see a few more rate cuts. It's all going to turn for him, data, and we're going to really pay attention to what the guy says when he talks about the future and all that good stuff, to see if potentially he might lower rates more, or potentially might be more nervous than we think. Anyways, guys, I appreciate you always watching. Thanks for the love and support. If I can help you, reach out. Remember, never too busy. No question is a dumb question. If I can run a scenario, let me know. I'm going to start sending scenarios out. And don't be surprised if my team, we start reaching out to you here in the coming week or two. Just start checking in. You might get some texts, some calls, some emails about, hey, you could refi, you want us to run your scenario, just to see where you're at. Why not? It does not hurt. We don't need to pull credit. We just take what your score was last time, send you out a loan quote, see if it makes sense. Great. If not, no big deal. If you're looking to buy it, new house, investment property, and that stuff, let me know. We do a lot of stuff here, guys, from the first time home buyer to the person in the military to that seasoned real estate investor and to the entrepreneur that was told no by your big bank. You have all that money in and you're bummed. So if any of those are you, let me know. Please reach out. Share this video with somebody. Love to hear from you, folks. Talk soon. I'll see you on the other side of the rate cut, and I'll be informing you what's next, and we'll break down what Jerome Powell said so we can really lock in what we think he's going to do.